So as a business owner, you've probably seen a lot of the ads that I show on this page. Bad credit, get instant loans, 48 hours, 25, $50,000, funding fast. We're all bombarded with all these kind of fast loans. They're very enticing, but there can be some, significant challenges with these loans. And today we'll talk about, how these loans work, what you need to look out for, and if you go after one of these loans, what you should be aware of. So with that, we will just continue. And I want to thank Prosper Portland for supporting this seminar series or webinar series. This is offered as part of the Inclusive Business Resource Network. All right, so the agenda for today. We're going to talk about the promise, what these loans promise and why they're so enticing. We'll talk a little bit about how these loans work, and then the reality, and then what you need to do as a business owner to avoid the temptation of getting these loans. And then if you must get these loans, and some people say it works for them, and I've heard businesses that say these work for them. If you must get one of these loans, what you absolutely must need to do when considering and closing on one of these loans. And then we'll wrap up with a quick overview of the capital advising services that I offer. So the promise or the temptation of these 48-hour loans is severalfold. One, it's a very simple, quick online application. You don't have to, go to a bank. You don't have to talk to a lender. You just go on a web page. You can probably do it on your phone and answer a few questions, click submit, and voila. It's very, very easy, as opposed to a more conventional bank lending process where there's lots of forms and financial reports and various documents that you have to submit. Most often, you do not, or I shouldn't say most often, quite a few of these online business lenders, they don't require your financial statements. We know a lot of small business owners, putting together financial statements is not a top priority. That's understandable, but it is needed for a bank loan. And oftentimes not having financial statements can be a barrier to getting a bank loan. Many of these online kind of quick lenders, they don't require financial statements or very simple financial statements, or just access to your tax returns, which when you're signing the papers, you actually give them authorization to go to the IRS directly and pull out the form. So you don't even have to upload anything. You just click a box, you sign, and they go to the IRS and pull your tax returns. Oftentimes, these are unsecured loans, meaning there's no collateral. Again, collateral can be a barrier for many business owners pursuing a more conventional bank loan. A lot of these loans do not require any collateral, so that's one less barrier to deal with. They can also deal with bad credit. If you don't have, banks like to lend people with 700 or higher credit score. If you don't have a credit score that high, or you have, some challenges in your credit file, you might not be able to get a bank loan. But oftentimes, a lot of these lenders can work with bad credit, and we'll talk about why in a few moments. And then the final thing is, approval in 24 hours and funding in 48 hours. With a bank loan, it's often weeks, sometimes even months before you can they can finish underwriting the loan, and then it'll be a few more weeks until you actually get the closing and the funding. Whereas, in this case here, they can give you a decision almost overnight, and money will show up the next business day in your bank account if you click, yes. And the promise that they kind of give you is that, your financial pains and worries will soon be gone. We as business owners, and I myself was one, there are times when you just don't have the capital. It might be a momentary thing, or it might be you're just trying to expand and grow and you just need some money to do, invest in something, and struggling to get that capital, from more conventional sources. Whereas these loans say, hey, we're going to give you a decision in 24 hours. If you're approved, you'll get money in 48 hours and you'll be set. So, these are very, very tempting, promises. That's why these loans are very, very attractive. How do they do this? Why can they do it, but banks cannot do this? It really boils down to two different things. One is a very different lending model. For banks, when they make a loan, and keep in mind where they get their money from. They get their money from depositors, and depositors want, many of us have our own bank account that we deposit our, money into. We put $1 in, we want $1 out at some point in the future. And so the way the banks are working is they have a mindset that all loans they must make, that all loans that they make must succeed. So as a result, they are very selective in terms of what loans they make, but the loans are generally pretty affordable and generally fair, from a market, kind of perspective. For these fast lenders, however, they have a very different model. They don't have their investors, they get the money not from depositors, they get these money from, more speculative investors who are willing to lose, money. If someone invests, $1, they don't necessarily need to have, $1 back. They may be willing to take more risk and possibly lose money, but then with the possibility of getting $3 back. And for that reason, it's okay that some, and in some cases, many of the loans fail. And if you continue with that, that means they don't have to be as selective in their underwriting and in their review and approval process if they're willing to let more loans, fail. And so that means, the way they make up for it is they charge more money for the loans. A bank loan, a business loan, or even credit card loans cannot be more than 30% interest, and that's often set by state and federal regulations. However, I've seen effective interest rates of 90 to 100% loans interest on these kind of fast loans. And so put that in perspective, if you borrow $20,000 from this loan and you repay it, in a year at 100% interest, you're paying $20,000 back in principal and another $20,000 in interest. So you're spending $40,000 to access $20,000 today. That is really expensive money. So they charge more, and sometimes it's not only in the form of interest. Sometimes it's in the form of fees. Maybe they have a monthly fee that they automatically tack on. Those are sometimes in the fine print, and you don't realize what's going on until after the fact. So they charge more in terms of interest, and they charge more in terms of fees. They could also charge more in terms of penalties. They can also be very aggressive in their collections or and servicing to make up for the losses. And so a typical bank loan, you have a payment that's due once a month. Pretty straightforward. We're all used to paying back loans on a monthly basis. Many of these fast lenders, they have daily payment requirements. Every day they will automatically take out, and it's also automatic. Bank loan is not necessarily automatic. You write a check or you authorize a payment to send money, to the lender. With some of these fast lenders, you don't do anything. They just automatically go into your bank account and pull out a fixed amount or a set amount every single day. Now, sometimes they'll start off as, oh, it's only $25 a day, and that's very enticing. It doesn't seem like a big deal, but $25 a day every day can be a big burden if you happen to be in a dry period or sales are not going as expected, or you're encountering some expenses. A lot of business owners that get caught up and get caught behind in these schedules, they spend a tremendous amount of their time pursuing, trying to find cash so they can meet these daily payments. And that time is taken away from running and managing their business. So that's a hidden cost, because that means your attention is not about the business. Your attention is raising cash so you can make the next daily payment. They also use a different underwriting model, and I alluded to this earlier. Banks, they do a very individualized analysis of each applicant. It's very time sensitive or intensive and information intensive. They need a lot of information. They need a lot of time to do this analysis. Whereas these fast lenders, They largely base the information on, information that is based in the cloud, or that's accessible electronically to them. There's a vast, there's a vast repository of information that is out there that they can have access to make these decisions about lending. So the information you provide to them is relatively little. It just basically confirms your identity and gives them authorization to look at these other data sources. And once you click approve, or you apply, they'll go to the IRS to pull your tax returns. They'll go to the credit bureaus to pull your credit history. They'll probably look at your DMV record, your any insurance records, any information that's out there on you or your business. They'll probably pull and use that information to make a decision on their loan. So that's why they're able to make these decisions really fast. That information is readily available. They just pull it, they get it instantaneously, and they run it through their automated underwriting models, and they can make a decision very quickly. So the reality is it is a very easy application. You can apply on for one of these loans on your loans on your phone. It's that simple. They have a very slick user interface, makes it really easy. As I said earlier, they give you very fast approval and funding. In fact, the approval can probably be done in like an hour, if in some cases, and the funding can probably be done right after that. The only thing that's probably holding it up is you kind of signing a digital document that gives, is basically saying that you're willing to accept the terms, and it takes overnight for the funds to arrive into your bank account. As I said, very high borrowing costs in terms of interest and fees, and very onerous repayment terms. Daily auto withdrawals, we talked about that. There's no prepayment savings. If you borrow, money from a bank, and let's say it's a 3-year loan, and things are going really well, and you are able to pay the loan in advance back, in 2 years instead of 3 years, you're essentially saving 1 year worth of interest. And that's very typical. Not all the cases, but very typical. That's how a business loan works. Whereas with some of these online or fast lending loans, the moment you click up accept, you owe that money. The money hasn't even arrived in your bank account yet, but you've already committed to owing a fixed amount. And if you repay the loan early, if you have fortunate or unfortunate circumstances, you still owe the amount that is stated, usually in fine print, at some point. So the only way you can, by prepaying a loan, you don't get any break. In fact, they may even charge you money for paying in advance. I've seen that happen. So you're locked into that interest rate, and if you're able to kind of pay off the loan tomorrow, you're already going to accrue the interest and rate expense that's associated with that loan. And then if you happen to be late, they're going to start adding fees. They're going to go very fast, send your loan very quickly to collections. They're going to be very aggressive in terms of pursuing, the recovery of the loan. If even if there's a little hiccup, in the loan. Or I've seen cases where they're going to force you to refinance the loan, and they'll say, "Hey, look, you're behind schedule. You still owe $10,000. Why don't we, kind of restructure your loan? We'll put you another loan. We'll bring down your loan payments, to half of what you're paying, but then you're committing to an additional financing cost. So yes, maybe you can make the monthly cash flow, but now you're committed to more expenses and more fees and more interest." And I've seen cases where business owners have gone through a couple rounds of this kind of forced refinancing, and what started out as a $10,000 loan ends up totaling $40,000 over the course of time. So the reality is that these loans can offer immediate relief after you get funded, but if your business fundamentals haven't changed, the pain will likely come back bigger and harder down the road. So something to just keep in mind as you're contemplating these loans, and understanding really the scenario, and then requirements, the needs that you have for getting this capital. So how do you avoid the temptation? It's just discipline. It's discipline in terms of forecasting. It's really important for any business owners to anticipate their cash situation at least 6 months in advance. The reason why a lot of business owners, get caught in this bind is that all of a sudden one day they find out, oh, I have payroll this week and I can't make payroll. I need cash. So they turn to one of these loans, and they get an instant loan. They can make payroll, problem solved. But the way to really avoid this is to, look at your cash flow next 6 to 12 months, see where, things might be a little bit slow. And, either plan for some financing right around that time when things are slow, or, change some of the fundamentals of your business so that you could avoid that cash flow crunch, at that time. Because seeking capital when you need capital is the worst time to kind of pursue capital. You are not in a good bargaining position, and you almost have to just take whatever comes along. Along the same lines, get your financial reports in order, and just knowing the health of your business, knowing the ebbs and flows of the finance of your business, as well as once you have your financial reports in order, it's much easier for you to go to a bank, a conventional lender, and get a more conventional business loan at a much lower cost, and under much friendlier terms. Also, as I alluded to earlier, talk to lenders when you don't need the money. If your forecast shows that you need money in 6 months from now, great. Talk to the lender and say, hey, in 6 months, I'm anticipating a slight cash flow crunch. We'd really, appreciate a line of credit, so that I can cover for that period. You're not under the gun. You have time to shop. You have time to compare. You have time to negotiate. Time to make plans. Time to consider other scenarios. And for a lender, having been a lender myself before, anytime someone needs the money tomorrow, that's immediate red flag. You're nervous. Why do they need the money? And so being able to say, I need the money in 6, 12 months, is really reassuring from a lender's perspective, because it says that you're doing the planning and the thinking that's needed. Another one is, I've seen a lot of cases where, a business owner might, have a 1 or 2 months that are a little bit slow, sales are not up or expenses a little higher. And they kind of think, oh, this is just an intermittent thing, things will work itself out, and they kind of stick their head in the sand and hoping it will go away. And sometimes that does work. But if it's, more than 2 or 3 months, or this is a recurring pattern, there's something fundamentally wrong with the way the business is structured and the finances is going. And so that's really more indicative of you need to make some changes to your business, as opposed to get a loan to kind of patch over, what is not working well in your business. And so I understand it's hard sometimes to make that distinction. As any business owner, you're always hopeful and optimistic that things will be better. But you should also be a realistic view of your business, and if you're constantly struggling with a cash flow struggle, that take a look at it, take a seriously look at it. You can also take advantage of the capital advising services that we offer. I'll talk about that in a moment, to help lay a good capital foundation for your business. And then finally, just realistically plan your growth based upon your situation. If you're in an industry that's growing 2%, and unless you do something that's really unique or different, don't plan a 30% growth, because you think you have, you're just, you got some secret sauce, or unless you really have that secret sauce. So talk to advisors, talk to peers, and kind of be realistic about what you can grow your business, and don't necessarily shoot for the sky. If you want to shoot for the sky, then maybe equity financing is more appropriate than debt. So if you must go after these loans, and like I said, I've seen business owners that have been pretty successful with these loans. The common traits that I've seen is one, read the fine print. Make sure you understand the terms. Make sure you understand the fee and interest structure, the timing. Know what they're expecting of you. A lot of business owners are surprised when every day, all of a sudden, every day, money starts coming out of the bank account. They didn't read the fine print. Shop around. Every single fast loan is different. And there are some programs that are very tailored for specific needs, and they're actually quite affordable, but they're tailored just for that specific need. So you're going to have to shop around. If this is the path that you want, shop around and look for a plan that ideally fits your industry and or circumstances. Another thing is just forecast and plan before you click accept. Look at the payment terms. Put those payment terms into your cash flow forecast and make sure that you have a high degree of confidence that you can make those loan payments, without pain. That's just knowing that you can make the business. Don't think that, oh, it's only $25 a month or day. I can handle it. Put it in your forecast. Make sure it looks well. Factor in a worst case scenario when you're in the dry period of your business, and maybe forecast it that if what happens if you're really dry, if sales go really slow during your slow period, how will that look? And if your business can support that loan, then yeah, maybe it can work out. But oftentimes, if your forecast says you're going to be behind the gun during the slow period, you're going to probably end up trying to get another one of these loans and just going further in debt. And that's the last point here is, avoid the temptation of getting more capital. I've seen a lot of business owners where they got this loan. It was fast, it was quick, it was easy. It relieved them of the pain almost instantaneously. And then a few months or a few years later, they find themselves in a similar kind of cash crunch. And they said, oh, well, last time I went for one of these loans and it cured everything. But then, what they don't see is that their debt level just continues to increase and increase. And they get into this kind of snowball cycle where they're just paying more and more to, pay off these loans.